There are over 20,000 cryptocurrencies, yet after stripping away narrative and hype, a rigorous framework points to one uncomfortable conclusion: Bitcoin alone possesses the structural characteristics of a durable store of value. This is not a question of technology speed or transaction throughput, it is a consequence of monetary economics and asset pricing first principles. In this analysis, we derive step by step why Bitcoin's monetary premium is non-replicable, and why altcoins, despite their innovation, are trapped in a zero-margin commodity business with valuations inflated by misplaced monetary hopes. By the end, the correct question is not which coin to pick, but how much Bitcoin to hold in a diversified portfolio. Karl Menger, one of the founders of the Austrian school, demonstrated that money emerges spontaneously from market exchange, not from government decree. Out of countless commodities, the most saleable, the one with the highest salability across time and space, becomes the universal medium. This salability rests on three sequential functions. First, an asset serves as a collectible. Next, it gains acceptance as a store of value. Only then does it evolve into a medium of exchange and unit of account. Gold took millennia to traverse this path. The key metric that predicts which asset wins is its stock-to-flow ratio, or SF. A high SF means that annual new supply is tiny relative to existing stockpiles, making dilution painfully slow. Gold's SF hovers near 60, while silver's, around 20, explains why silver lost the monetary competition to its denser cousin. Bitcoin, after its 2024 halving, crossed above gold's SF, and its terminal issuance schedule is mathematically zero. Fiat currencies suffer from two incurable flaws. The first is seigniorage. The issuer prints new units and spends them at current purchasing power before the dilution ripples through the economy. This acts as an invisible tax on every holder. The second is the Cantillon effect. New money enters the financial system at privileged nodes, central banks, primary dealers, and institutions closest to the printing press, and only later diffuses to wages and savings. Over the last half-century, USM2 has compounded at roughly 7% per year, that is the default annual wealth tax paid by anyone holding fiat-denominated savings. The demand for a digitally native store of value is not a speculative fad, it is continuously manufactured by the infinite horizon dilution of fiat balance sheets. The only question is which asset will fill that void. Every financial asset derives its value from exactly one of two mutually exclusive and exhaustive sources. The first is the discounted present value of future cash flows. Equities, bonds, and income-producing real estate inhabit this category. The second is a monetary premium. An asset generates no cash flows, yet the market collectively assigns it a value because it serves as a store of value, a savings vehicle that transcends time and jurisdiction. Gold's price, for example, is over 90% monetary premium. Anything that lacks both cash flows and a monetary premium must have a fundamental value of zero. All interim price movements are mere Keynesian beauty contests, speculative churn around a zero mean. For any cryptocurrency, therefore, two diagnostic questions suffice: are its cash flows sustainable? And can it capture a durable monetary premium? Ethereum, Solana, and similar blockchains do generate cash flows through transaction fees. However, block space is a commoditized good. New chains can fork the codebase and offer lower fees, imposing intense price competition. Ethereum's rollup-centric roadmap effectively cannibalizes its own mainnet fees, moving high-volume activity to Layer 2s where the L1 captures far less value. At its 2021 peak, Ethereum's annualized protocol revenue exceeded $10 billion. By 2024, after the Denkin upgrade and rising L2 usage, that figure had compressed drastically. Solana attracts usage through ultra-low unit fees, but that very cheapness means that even massive user counts generate only a few $100 million in annual revenue, highly cyclical and often dependent on memecoin speculation. In a classic industrial organization framework, margins in a commoditized market with free entry tend toward marginal cost, and the on-chain data confirms that trajectory. A monetary network derives its utility from the number of participants who are willing to accept and hold the asset. Metcalfe's law states that the value of a network is proportional to the square of its user count. When two networks of size n and m merge, the combined value is n plus m, superscript 2, which is greater than the sum of the individual values n superscript 2 plus square meter. This nonlinearity creates an overwhelming gravitational pull toward consolidation. In a store-of-value competition, a single dominant network can offer deeper liquidity, lower volatility, and stronger reflexive adoption, all of which further increase its attractiveness. History supports this. Within a single economy, one currency usually dominates. Internationally, the dollar holds a disproportionate share of reserves, and in the realm of physical stores of value, gold stands alone. The monetary premium is a winner-take-all prize, and the few thousand projects that call themselves digital gold are chasing an ecological niche that supports, at most, one survivor. A store-of-value asset is intrinsically a long-duration claim. Its price today is the discounted expectation of its future price, adjusted for the probability that it dies. We capture this with the disaster rate lambda, the instantaneous probability of catastrophic failure per year. If an asset has probability lambda of vanishing in any given year, $1 of expected future value must be multiplied by 1 lambda for each year of waiting. Over long horizons, small differences in lambda compound into enormous valuation gaps. An asset with lambda equals 1% has a 30-year survival discount factor of roughly 0.74. For lambda equals 5%, that factor drops to about 0.23. A 3-to-1 ratio from only 4 percentage points of annual risk. This is the core insight: the battle for monetary premium is not won by the fastest innovator, but by the slowest to die. Lambda lives in the exponent, and time is merciless. We can decompose lambda into 4 observable dimensions. Governance risk: does a centralized entity or insider group have the power to alter the protocol? Bitcoin has no CEO, no foundation treasury, and no pre-mine. Changes require near-universal consensus. Ethereum, by contrast, has a core development team and roadmap decisions that concentrate power. Scash once had a built-in founder reward. Technical risk: how often does the protocol suffer critical failures? Bitcoin's conservative codebase has never been compromised in over 17 years. Every hard fork of an experimental chain resets the technical survival clock. Regulatory risk: has the asset been classified as a commodity by major jurisdictions? Bitcoin has spot ETFs and is treated as a commodity by U.S. authorities, while most altcoins face unresolved securities law exposure. Scarcity risk: can the supply schedule be changed? Bitcoin's 21 million cap is guarded by the same governance rigidity that makes it hard to change anything, a feature, not a bug. When we populate the lambda decomposition with realistic estimates, the hierarchy becomes stark. Bitcoin's governance lambda is essentially 0 because there is no identifiable entity to coerce. Its technical lambda has been driven down by Lindy effects, its regulatory lambda is close to 0 in major markets, and its scarcity lambda is 0 under the current social contract. A typical smart contract platform, however, faces a non-trivial governance lambda due to foundation control, a moderate technical lambda from frequent upgrades, an elevated regulatory lambda because of potential securities classification, and a scarcity lambda that is non-zero because monetary policy can be changed by a small group of developers. The result: Bitcoin's total lambda likely lies around 0.5% per year, while an average altcoin faces a combined lambda in the range of 3.7% or higher. Over a 30-year horizon, this gap implies that Bitcoin's survival probability is an order of magnitude greater. The Lindy effect states that for non-perishable things, technologies, ideas, protocols, expected remaining life increases with current age. Every day Bitcoin survives without a fatal flaw statistically reduces its future hazard rate. Mathematically, if we model failure times with a Pareto distribution, the conditional expected remaining lifetime is proportional to the age already achieved. Bitcoin's 17 years of uninterrupted operation include surviving exchange collapses, mining centralization scares, hard fork attempts, and outright bans by nation-states. Each survival event is a stress test that other chains have not yet passed. A newer chain with 2 years of history might have excellent code, but it lacks the accumulated evidence of resilience. In the long-duration contest for monetary premium, time itself is an unassailable competitive moat, and Bitcoin's moat widens every day. Among thousands of crypto assets, Bitcoin alone has achieved unambiguous regulatory clarity in the world's largest capital market. U.S. authorities, including the CFTC, classify Bitcoin as a commodity, and it has become the only crypto asset with a spot ETF approved and widely distributed. This status is not an accident, it is a direct consequence of Bitcoin's decentralized launch. No issuer, no fundraising, no promotional team. Regulators cannot easily target an entity that does not exist. In contrast, many smart contract platforms conducted initial coin offerings, have foundations with treasuries, and maintain teams that can be subpoenaed. Their tokens constantly live under the shadow of potential securities enforcement, which introduces a structural lambda_reg that Bitcoin simply does not face. The regulatory gate is now closed to latecomers. Subsequent spot ETF applications for other tokens have faced insurmountable challenges, entrenching Bitcoin's moat further. Every model is a simplification, and this one is no exception. First, Bitcoin's lambda is not literally zero. Tail risks remain, including cryptanalytic breakthroughs against elliptic curve signatures, geographically concentrated mining power, and the fragility of social consensus itself. Second, the cash flow critique of competing chains could be too pessimistic. If a platform builds an irreproducible institutional settlement network or a deeply embedded developer ecosystem, its fee-based moat might sustain a genuine DCF valuation. So far, we have not seen such a moat, but the possibility cannot be dismissed. Third, winner-take-all may not be absolute. Silver survives alongside gold with a monetary premium that is 1 to 2 orders of magnitude smaller. A distant second-tier store of value could coexist, though its premium would be tiny relative to Bitcoin's. These caveats affect confidence weights, not the directional conclusion. We have now built the full case from first principles. Fiat seigniorage produces relentless demand for a non-sovereign store of value. Asset pricing tells us that value comes either from cash flows or from a monetary premium, and Alt-L1s are trapped in a commodity margin business that cannot justify their market caps. The monetary premium is a winner-take-all network effect governed by the disaster rate lambda. Bitcoin's lambda is structurally the lowest across every dimension, and time, via Lindy, widens that gap. The correct question, therefore, is not which cryptocurrency to bet on, but how much of a portfolio should be allocated to Bitcoin as a distinct store of value asset class. This is a risk management and asset allocation decision, not a horse race. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.